Thank you for joining us for another edition on our weekly webinar series with Quest Trust Company. I'm Nicole Bako, an IRA specialist, and I will be your host today. Today's speaking is Juan Deshon, a fellow IRA specialist on ESAs and HSAs and the power of those very special accounts. Before we get started, I just have a few slides to share on the latest things that's going on right now at Quest Trust Company. All right. There we go. All right. Thank you so much for joining us today. So make sure to check out our client portal. We've really revamped this since April. You can do all of your investments now. You can say goodbye to that direction of investment. You can upload your FMV information, get all the information to your account. So make sure you check that out. Of course, our events coming up is the Sidra Social or Self-Directed IRA Social. You can see the dates on the screen coming to an area near you in our Houston, Dallas, and Austin offices. So make sure to register for this. The guest list is limited to 50 people. So make sure you sign up early for this one. And if you can't come at the last minute, please let us know so somebody else can. All right, and our monthly reward right now is still going on. We carried this from July to August, so you can see the qualifying deposits on the right and the fee credits that you would get on the left. So existing clients, new clients, please let us know if you're making one of these transfers. We'd be happy to credit your account for these fees. All right, and make sure you're getting in touch with your IRA specialist to help you with all things self-directed IRA at Quest Trust Company. We're really easy to get in touch with. You can reach us there on the QR code. The chat section of our website is actually manned by us, the IRA specialist and the transaction specialist. So we're happy to help you. Give us a call, 855-FUN-IRAs, or email Juan or myself at the emails below. All right, so that is enough of me. Now it is time for Juan Deshon and his webinar. Thanks so much, Juan.
Yeah, thanks, Nicole. So yeah, guys, keep joining. We appreciate you guys joining these webinars on a weekly basis. We're trying to provide as much education as possible. Just so you guys know, we're also always open for new ideas. If you guys want to see things, feel free to email one of us and we'll be able to implement that in the coming months. But let me go ahead and share my screen here. All right, so you guys should be able to see now the HSAs and ESAs. So we're going to talk a little about the, or all about the HSAs and ESA accounts today. There are specialty accounts, right? There are the account types that individuals can take advantage of today in specific different ways. And I'm going to break down kind of each of them, starting with HSAs and then into ESAs, how they're utilized, why there are accounts that you may want to consider, and how they may be able to assist you guys, because I don't think they're accounts that get talked about too much. Individuals, for the most part, have HSA accounts through their employers, or may have one, but kind of just know I put some money in it and I use it for expenses. But there's more to that. And then with the ESAs for children, not a lot of people know about these accounts. So I think it's good to kind of get out there and just understand how they can possibly benefit your children, your grandchildren, so on and so forth. So I like to keep things casual during my classes. So I have the chat box open right here as well. So if you guys have any questions throughout the presentation, feel free to use the chat box. Nicole is there, but if I see anything I want to kind of interrupt the class about, I'll definitely bring it up. So definitely keep things casual. Don't be afraid to do that. So let's get started. So quick disclaimer, I'm not a financial advisor, right? I don't give tax legal investment advice. I'm not a CPA or attorney. My job, and as well as Nicole's, is we're the nerdy people who have read the publication and have studied the IRA code to understand how these accounts are utilized, what rules they have and what they can and cannot do, what makes them so great, and to help people use that information and take advantage of that. So that's really where we come into play, right? But I highly encourage, with any of the situations, any investments you're looking to do, any accounts you're looking to utilize, you bring in your team of experts, right? Your tax, legal, and investment experts that will help you determine whether or not this is a good path for you. Whereas we can provide maybe just the education on what they can do, and then you can bring in your other professionals to integrate that into how you can utilize what we just taught you in your daily life. So enough about that. One thing I want to show you is, why are these accounts important? And throughout my presentation, I'm going to show a little bit of a few different statistics that I've researched through some sources on why HSAs and ESAs are a topic that you should be talking about or learn about. Out of our top 8 financial worries, 3 of them are specific categories in not having enough money for retirement. Or I know as a young individual, people my age typically don't even think about retirement. I do just because I'm in this space, but most individuals aren't thinking that far ahead, right? So retirement is something that we're always trying to think about and put in people's minds, that you want to take that into account. And as cost of living continuously goes up, it's something that you want to pay more attention to, especially depending on what states you live in, right? The other thing is going to be medical costs, right? Medical costs are also going up. So that's another thing that people are not being able to pay, not saving enough to be able to pay for when they do get sick. And that happens unexpectedly. We don't have a crystal ball. We don't know when we're going to get sick. And anything could really happen at any second of our day. So it's really good to be prepared at the end of the day. And a lot of Americans are worried about, do they have enough, not only just in retirement, but just in general for those medical expenses. I would say even more in retirement, because you're getting to older age and you don't have constant income. You want to make sure that you've done yourself a service and provided at least a nest egg for medical expenses as well. And then lastly is going to be education. Another concern of Americans is going to be the education side. How I pay for college, how I pay for the higher education. Do I need to get my master's now? Things like that. You want to make sure that, as a parent or grandparent, maybe you can give that opportunity to the children to be able to kind of give them a little extra head start there. So we'll talk about that and how those things can maybe combated with the use of HSAs and ESAs. It's not to solve all your problems. It's not going to solve them, but it is an extra tool in your tool belt that you can utilize towards these worries that we all have. So just to break it down, we're going to go over very briefly and quickly. I'm going to run through the 7 types of accounts and kind of what in general is an IRA account. For anyone that's on here for the first time, I want to make sure we create that standard base. Then I'm going to go into the HSAs and the ESA, specifically starting with the HSAs and then going into the education savings accounts and their pertinent information. And then lastly, we're going to close it out with where do you get more information, how do you learn more, how do you get in touch with us, etc., especially for those newbies. And again, thank you guys for joining. So very quickly and briefly, I'm sure if this is not your first time, you could probably almost recite this yourself. What is a self-directed IRA? The IRA is no different than any IRA account you have anywhere else. An IRA here, an IRA at Fidelity, Charles Schwab, Merrill Lynch, you name it, Edward Jones, all the same. They're all governed by the same exact rule in the body, right? The difference is what they can be invested into. So when I mentioned the term self-directed IRA, it's not a legal term at all. Self-directed is we use it for marketing purposes. Just associate that with, if it's a self-directed IRA, then you can utilize that account towards non-traditional assets, private investments, real estate, promissory notes, things of that nature, private placements, etc. So that's really the big difference on what self-directed is. That's what makes it self-directed. It's not the IRA itself. It's the company typically you're with that'll allow you to divert those funds to different types of buckets. In this case, at Quest, we only deal with self-directed. So we divert your funds or allow you to divert your funds into non-traditional assets like real estate, just as an example. So that's really what self-directed means, right? Again, no different IRA-wise. All the rules that we're going to go over today, even if you have an account at Fidelity or Bank of America or Merrill Lynch, those rules will still apply. Those will still apply whether it's self-directed or not. So keep that in mind. Why do people sometimes go to self-direction? What are some of the benefits? The first one being diversification, right? So the biggest thing is you don't want to put all your eggs in one basket. So you can put some money in the market, right? Let that ride the market a little bit. And you can put some money in private assets, right? A private placement, maybe buying a rental property, maybe investing into local real estate investors by loaning them funds. So you can kind of utilize your funds in different locations. You don't have to choose one over the other. You can do them simultaneously. So one of the biggest benefits, and I think, is just clearly diversification. And I think a true diversification, because you're having funds in different buckets of money, sourcing income from different directions. The second thing is going to be tax savings. The reason why we use these IRA accounts and why they're appealing to us is because they give us some sort of benefit. Whether that be on the front end or the back end, what I mean by that is whether it gives you a tax deduction or whether it gives you tax-free gains in the long run at retirement, that's going to give you some sort of tax savings and some sort of incentive to utilize these accounts. I'll give brief examples of those when I go over the 7 types. And then the other one is going to be social investing. So this one's kind of an interesting one, but essentially it kind of has that feel good aspect to it. You know, as an individual, personally myself, who's in loans to real estate investors, I know that my money is going to local workers, putting local people to work, and actually building a home that's not too far from where I live. I can see and is now being used to house, you know, a family. So being able to invest in the private side does allow you to actually see your investment on a day-to-day basis and kind of be more involved, I guess, and gives you that kind of satisfaction. Whereas the market is very, very passive and pretty much out of your control to a certain point. There's not too much control you have over what Tesla's going to be doing today and tomorrow, right? Just as an example. So that's kind of nice about social investing and kind of the self-directed side. The biggest thing we say is take control of your retirement and invest in what you know best. As individuals here today in this webinar, by joining on to learn about these accounts and it's specifically self-directed, it tells me that you personally are either learning or know about the self-directed space or the private asset space. Maybe you are a real estate investor. And if you are applying that same knowledge you have that helps you put bread on the table, you can apply it towards your retirement account and will help you put bread on the table later on in the future, right? So applying that same knowledge towards your retirement savings might give you a better chance of giving yourself a better return on your investment money, as opposed to letting someone else manage it. That's kind of the idea behind it. Invest in what you know best is kind of a motto we have here at Quest. And I see it really, really works because someone who is a great real estate investor can probably make some really good money also tapping into their retirement capital, as opposed to letting just a advisor kind of throw in the market for them where they maybe don't have an understanding of it, right? So keep that in mind for anyone here. It's for the first time, why you might want a self-directed IRA, why you may want to use it. It's just simply because you can apply your own personal knowledge to it. So to briefly go over the personal plans, we kind of group them into three different categories, right? So the first one we always hear about is going to be a traditional IRA account. Now it says here at the bottom includes rollovers. And by that, I mean some custodians will call this rollover IRAs. I had a conversation not too long ago with someone that said, I have a rollover IRA because what happened was I left my job. That account, that 401k account, moved over to an IRA at the same place or some different brokerage, and I haven't really touched it since. And typically those are rollover IRAs or traditional IRAs. Those plans hold pre-tax dollars, meaning the money in there you haven't paid taxes on. You may have put money in there and it maybe gave you a benefit on the front end, like a tax deduction, but the growth and the money in there technically is a bucket of money that the IRS has not tapped into. And they will eventually when you take the money out for personal use, not for investments, but for personal use. So we see those are very, very common because most of America has wealth in 401k plans, TSPs, 403bs, and those accounts all hold pre-tax dollars. And so conveniently, whenever you move those funds to an IRA account, the convenient move is really to move it to a traditional IRA, not deal with taxes now because no one likes taxes now, and just continuously defer those taxes till later on when you really need the funds. Now, another account that is talked about a lot is going to be the Roth IRA account. And this one is a very sought out account. And every guru out there, a financial guru, says everyone should have a Roth IRA. And the reason being is because simply put, this account gives you tax-free growth. So as opposed to giving a benefit on the front end with the tax deduction, this one doesn't give you that. You put money in, and then as you invest it, that money grows tax-free, or the IRS says, the contract between you and the IRS basically is saying, if you leave that money in the Roth IRA for a certain period of time, and there's a certain age that you meet, after that point on, anything within this Roth IRA, even what you've earned from investments and have not paid taxes on since, is tax-free to you to use for personal reasons. So it's very appealing to some, right? And people have both. Very commonly, people have both. People move money from one account to another. By moving funds from the traditional IRA to a Roth IRA, that's what we call Roth conversion. If you see a little banner down there, there's another class strictly on Roth conversions. You can watch it online on our website or just call us and we'll discuss it. But high level, conceptually, it's just simply moving pre-tax dollars in that bucket of money over to a Roth IRA and saying, I would like to pay taxes on the amount today that I have in my traditional IRA account. Let's say it's $1,000. And then eventually I'm going to grow that $1,000 to $100,000. Why rather make that growth in a Roth IRA? Because I know that 100,000 eventually will not be taxable to me in a Roth, but it will in a traditional. So it's kind of like paying taxes on on the acorn, not the tree. So if you kind of put it in that perspective, it's kind of an obvious move, but in real life situations, it might not be as easy. But talk to us about it and we'll kind of go over how to do that. So Nicole right now just put in the chat box our education center, which directs you directly to all those videos I'm talking about. So you'll see banners in some of the prior presentations or the prior slides, on different classes. If you want to learn more about that topic, the education center is where you want to go. The third one is going to be employer plans. So this one, we group them into 3 accounts. SEP, we have simples and IRAs, individual 401ks and individual Roth 401ks. I'm not going to spend too much time on these because I can spend a whole class, an hour and a half or 2 on these accounts themselves. Now, SEP, simples, and 401ks or solo 401ks are accounts for individuals that have self-employment income. Individuals that may have employees, that may not have employees, but are looking for a way to create themselves their own 401k plan because they might not have that at the corporate job. So if you're an individual that's self-employed, you might be able to open one of these accounts anywhere. But if you want to self-directed, you can do so with Quest. Now, there's a lot more to uncover about these accounts, but I highly encourage looking into them. They allow for larger contributions. They do give tax incentives like tax deductions. The Roth 401k gives you tax-free growth. If you have a small business with employees, you can provide them similar benefits as well, but not having such a costly 401k plan that takes a lot of administration. These are very cheap 401k plans, put it that way. Now the special plans, now we're going to go over these throughout the entire presentation, so I'm going to hold it on this one for now, right? So we're going to talk about this in just a second, but basically the Coverdell Education Savings Account, or ESA for short, or CESA for short, and the Health Savings Account, or HSA for short. Very quickly, the investment choices. The ones here at Quest that we most commonly see are right here in front of you. So we grouped them up into categories as well: real estate, private entities, and promissory notes. But as you can see, that's not just one thing, right? There's actually a lot more that you can invest into. But for the most part, here internally, we like to group them into 3 categories to assist you, depending on what type of transaction you are doing. Right, real estate is when you're taking title to real estate with an IRA account. Private entities is when you're going in on a JV, an LP, investing into LLCs, and promissory notes are simply when you're loaning the funds. You are a lender, a private lender, right? There's also classes in our education center on those topics and how to invest in those different asset classes as well. The steps to have an account is very, very simple. Before you transition to the real meat of the presentation, the first thing you got to do is open an account. Right, you have to have an account open to, it has to be self-directed with a self-directed custodian to be able to do these kinds of transactions. Second step we'll help you out with is funding your account. Are you funding it from an old 401k? Are you funding it from a pre-existing IRA or an IRA that's kind of stagnant, or you are actively using it? Are you funding it for an IRA? Or neither, are you just simply making contributions to it? Contributions are personal deposits into the account from your own checking or savings accounts that you want to put in on a yearly basis or quarterly or monthly, however you want to do it, for your paychecks. Step 4, complete investment forms. Once you obviously located your investment, you want to complete the investment forms. There's some documentation involved. Quest as your custodian typically will review documents to make sure you are not falling out of line. And 5, we fund it, right? We're very, very quick on funding. We have 24 to 48 hour processing times and funding times. So definitely reach out to us if you need anything and to kind of get a feel for how you would be able to make something happen. The biggest thing about the self-directed IRA accounts in general is it's self-directed. So you are finding those deals. You are the one that's going to be locating or trying to find the opportunity for your IRA account, then giving us a call and saying, I like to do this. As Quest, what we'll do as your custodian is going to make sure, again, you're not falling out of line, not doing anything prohibited and not allowed in these IRA accounts. And then, of course, just holding that asset, holding the capital so that you personally never have to take the money out personally and not be taxed on it. We hold the account, we hold the paperwork here in-house, and we are that trust company that holds the asset. So hopefully there's no questions so far. I ran through that information. I left out a whole lot because I want to get into the meat of the presentation. But again, we also have a basic class in our education center. So this number right here, it means something. Ultimately, this number right here is what seems to be what an individual or a couple may need saved up at retirement to be able to take them, for the rest of their life. Now, that information, I got it from a few sources, but according to Fidelity retiree health care cost, they estimated in 2021, any couple retiring after age 65 needs approximately $300,000 saved after tax to cover their health expenses that they might have moving forward. Now, this definitely will depend. This is not a for everyone thing. This can be less, this can be more. It depends on your personal situations. It depends on, how healthy you are, what you have going on, of course, right? But in general, just seeing that out there that they've done this through studies is kind of alarming, right? That's a lot of money that you need to use toward medical expenses. Another study I got as well, another survey they did through patients is kind of what type of groups of people are concerned about medical costs. I found this kind of interesting, so I threw this in here. And so if you look at the generation category, the millennials are the individuals that are most concerned with their medical costs. Maybe it's because they're starting to get, go to visit doctor a little bit more than they were before, right? Millennials, I believe the high end of millennials are about 30-ish years old, and the low end is, I believe 24, 23. So those individuals are young, and they're maybe getting into more medical costs. Maybe that's why. They're more concerned with the medical costs, and they're seeing it rise, of course, and especially with COVID and everything. It's more of a concern. The geography, so urban residents seems like the most concerning type of people. Maybe because there's more people, more dense. The household income. So this was pretty interesting to me. People making less than $100,000 are the ones most concerned, and as well as everything's kind of pretty even there. But of course, if you're making less, you're probably more concerned about what the cost is going to be able to take care of those medical expenses when they come up. And then family groups. So the biggest one being with children under the age of 13. This kind of makes sense, right? With children under the age of 13, you go to the doctor a lot more. You have them to take care of. They may not have jobs yet, etc. So this is just, I found it very interesting. This is the kind of demographic of individuals really concerned about their medical expenses. So just want to give that information to you guys and just see it's actually a big concern. And then through, again, the research, I've seen that, and personally myself even, there's a rising cost of healthcare. And there's multiple factors that you can kind of point out that may be the reason why, but no one has a crystal ball. But what I believe in, what through research I saw, is obviously one thing, supply and demand, right? That's just basic economics. That's how it works. Cost is going to rise because the demand is high and the supply is, getting lower. The big thing as well is, which was interesting to me, is baby boomers. Right, the baby boomers right now most of them are now going to be enrolled into Medicare, but that's going to affect and increase the cost of coverage just in general, because most of them that's a large group of the population. And then the last thing is administrative costs are increasing as well. Administrative costs on the doctor side, them to run their practices, is increasing. The technology is getting better, but it's getting costlier. So that means that obviously they're going to have to charge more. So administrative cost is increasing. It's going to cost us more as well to pay for these medical visits. And so bottom line, when you just put it all together, and there's a lot more reasons why this is going to go up, but bottom line is that health expenses are not going down. They're going up. And we got to take care of that. So let's get into the accounts and how maybe I can provide some education here today on how maybe an HSA will be able to help you out in mitigating and preparing for this cost. So the first big thing is, one of my favorite things about the HSA account is it gives you the best of both worlds. So as we mentioned before, some accounts give you tax deductions and some accounts give you tax-free growth. No account except for the HSA gives you both. So the HSA is the best of both worlds, because as you put money into the account, the IRS comes in and says, hey, you put money towards medical expenses, we're going to reward you for that. And you could use that as a tax deduction, right? And then at the end, they say, if you use the money in the HSA account, whether it be what you put in or the profit you made from investments, as long as you're taking it out for a qualified medical expense, and we'll go over what that is in a second, it will come out for you completely tax-free. You don't have to report it as income, as you would in a traditional IRA, for example. So it's a huge, huge benefit. Just to give you an example, I've used the HSA for the deduction, and I've used the HSA. I use it actually constantly. I use it this morning, not this morning, for a medical expense. I had to go to the chiropractor. So there are a lot of things you can use the HSA plans for, and you're using tax-free money that's not going to be added to your income, which is a huge, huge benefit for you and your family. Now, what are the qualifications for it? So not everyone can have an HSA plan. They do require that you qualify, right? So first thing being, you have to have a high deductible health plan. Now, there isn't a specific number. The IRS says what qualifies as high deductible, right? I've talked to multiple people, and all their deductibles are the same, or no, sorry, they're different, but they may or may not be considered high deductible. So definitely check with your insurance providers, just saying, hey, is this a high deductible health plan? Or you may know off the top of your head. Second thing is you cannot be enrolled in Medicare, right? And the last thing is you cannot be claimed as a dependent on someone else's tax return. So for children, they usually don't have these, right? But maybe if you're a husband and wife, well, then if one of you claims the other, well, then that you can only have one HSA plan. But don't worry, you don't miss out on that. That HSA plan can still cover your entire family, but just make sure you're not claimed as a dependent on someone else's tax return, and you also meet the other two qualifications, and you can have an HSA account. Now, I kind of alluded to it earlier, that you can have multiple accounts in different places. Personal experience, I have 2 HSAs. Now, to the IRS, they see this all as one. They don't care where I have my HSA plans. They just are concerned about how I'm using it, make sure I'm using it correctly. I report that as such. But I can have multiple. And the reason why I do that is I diversify when I invest it. So I have one at Bank of America and one here at Quest Trust Company. And the reason why is because I do self-directed deals and also throw some money in the funds. So I can do that with my HSA plan. And not only that, is also Quest is not a bank. We don't give you a debit card for your funds in HSA. We simply invest into these non-traditional assets. You probably wouldn't want a debit card anyways if you're investing it into a house or a real estate asset or a private placement or an asset where really kind of passive. You're not really doing much with it. You're kind of sending the money off. But in cases of a Bank of America as being a bank, they actually give me a debit card. So I use that debit card to swipe for, expenses. When I go to the doctor's visit, I can use that. So using that strategy, I think, is very helpful. So I share it with everyone, because I want to drive the point across. You don't have to have one. You can have multiple. Now, what cannot be done is you can't double dip. What I mean by that is you can't double dip when it comes to contributions. Contributions are the amount that you personally can put into the account from your checking or savings account to kind of beef it up and use it for expenses, for deductions, for investments, of course, right? So there's 2 types of contributions we see are amounts. The first one is going to be the single. So this is for an individual that does not have any dependents or doesn't claim any dependents. In this case, your maximum contribution is going to be $3,600. This is for the year 2021, by the way. Now, if you do have a dependent, at least one, then you are considered a family. And here your maximum contribution just doubles. So you have $7,200 that you can put in and use towards deduction as well towards your income. Now, the catch-up contribution, like any other IRA account, is what this means is, after a certain age, the IRS says, hey, you guys can put an extra $1,000 into the account to kind of help catch up and put more money in towards retirement for the medical expenses. So after the age of 55, you have an extra $1,000, whether or not you're single or you have a family. Now, some of the points here down in the bullet points is open deadlines and fund deadlines and the last month rule are very important to understand. The open deadline means that in order to open an HSA plan for, let's say, the year of 2021 for this year, you have to do so by April 15th of 2022, right? And you have to fund it by that same date as well. So if it's April 16th, and by the way, that's tax filing deadline. So if it's past tax filing deadline, unfortunately, you are now in the new year. You can't backtrack it anymore. So if you're an individual right thinking about it, you still have some time. Now, there is a last month rule for individuals. So what this means is that under the last month rule, you are eligible for an HSA as long as you had an HSA for a certain period of time. So for most taxpayers, you had to have had it before December 1st of the previous year, very minimum. So you can't just set up an HSA December 31st and then contribute for the year 2021. You've had to have had it at least for a certain period of time before that to be able to use the 2021 contribution. If not, you're only subject to 2022 if you were after December 1st. So just keep that in mind. But for the most part, if you have an HSA plan or you're looking to set one up, you still have some time to contribute for 2021 up until April 15th. So, and come January 1st, if you had an HSA plan, you can contribute for 2021 and for 2022. So keep that in mind. So what are qualified medical expenses? What can they be used for? So doctor's visits, like as an example, I went to the chiropractor with it. I've gone to the eye doctor with it. Those are very common ones that I go to. The second one is going to be ambulance expenses, vision and dental, hospitalization, medications. Now these are prescribed medications. In some cases, I know for COVID, they allowed for non-prescribed medication as well. For birth control, chiropractic expenses, there you go, that's one I did. Fertility enhancements, therapy, x-rays, and much, much more. The exact publication that reads out what you can do actually as much as possible is actually IRS publication 502. So I see a question here that I'm actually going to interrupt the class for. Can an HSA plan be funded from an IRA? And I'm going to hold on to that. And the reason why I want to stop the class is just because I'm going to hold on to that because I do touch on that in just a second. So hold that thought. So just right now, qualified medical expenses are this, but much, much more. See IRS publication 502. But just to give you an idea of what's not included, how you can kind of tell what's not included, health insurance premiums are not, with some exceptions, right? For example, Cobra. Unnecessary cosmetic surgery. So if you're not a fan of your nose, you cannot go get a nose job for that sole reason. However, if it was maybe impeding you from breathing because for some reason, well, then maybe that would work. Medical marijuana does not count. Funeral expenses does not count. Maternity clothes does not count. Teeth whitening does not count. Although it's at a dentist, it's not a need. It's not necessary. So the kind of rule of thumb is, do you need it for your health or do you not need it for your health? Right. Again, you can see publication 502 and it goes through a bunch of things of what you cannot use it for. A funny thing once that happened is an individual got a doctor's letter actually to be able to buy a hot tub with their HSA. They needed it for rehabilitation, and they were able to use their HSA to buy a hot tub. Now, they definitely don't say that in publication 502 that you can or cannot buy a hot tub. If it was a regular situation, you just wanted to kind of relax on a Saturday night or a Sunday, I wouldn't buy it. But if your doctor deemed it necessary, there may be ways to get around it, right? So that's just an interesting situation that I've seen in my experience. Now, how does the IRS know? How does the IRS know what we're using it for? Well, obviously, everything there's receipts, there's, when you're using these expenses, and really it comes down to, will the IRS audit you? Will you be able to prove, right, that distributions were exclusively paid to reimburse or to pay for qualified medical expenses? So holding on to receipts, especially very big ones for big costly expenses, is very, very key and important that you do if you're going to be using your HSA or having some way to backtrack and then go back to look at what you paid for. They have not been paid from another source. And the medical expense has not been taken out as itemized deductions in any year. So just keep that in mind. How do you keep sufficient records is really just keep your receipts, guys, and just understand that you're using it for medical expenses, qualified ones, and not, cosmetic or things that you just want. All right. Here's some fun facts where we're going to touch into that situation. So one time you can fund your HSA plan with a transfer from a traditional or Roth IRA. This is a tax-free transfer. So what does that mean? I think this is huge. That means that if an individual with a traditional IRA that you got from, rolling over a previous 401k or something, and your contribution limit is $7,200 for the year because you have a family, but you're under the age of 55. Well, then you could theoretically move some funds from a traditional IRA to an HSA up to the contribution limit. So in this case, in this example, $7,200. Now that's taking pre-tax funds and putting it into an HSA account, and then immediately distribute it if you needed to, or use it to pay for a medical expense, tax-free. So what you've done there is you've taken pre-tax dollars from a traditional IRA and you've taken it out tax-free by moving it to an HSA first. Now, this can't be done every single time because if not, I feel like a lot of people would do this. This only can be done once in a lifetime. Again, keep your receipts, keep your records of it, but keep that in mind. It's a very, very neat thing that you can do. You can pay for prior year qualified medical expenses as long as you incurred the expense when the HSA was established. So what does this mean? So this means that if today, for example, I have an HSA and tomorrow I have to go undergo some medical procedure, and say it's fairly costly, well, I don't have enough funds in my HSA account. No problem. I pay out of my own personal pocket. I deal with it and I pay. Years down the line, I've been investing my HSA account and I've grown it. And I've grown it to an amount where I would have been nice to have for that medical expense way back when. However, what they allow you to do is now reimburse yourself or take a qualified distribution from the HSA account for the amount that it was. So let's say it cost me 10 grand and now I had 10 grand in my HSA. This is maybe years later. I can distribute $10,000 completely tax-free for the purpose of the reimbursing myself for that past expense, as long as that expense happened while the HSA was in play. So that's a huge thing because A, the expense has already been paid. So now you're reimbursing yourself years down the line. And what can you do with that money? Well, it's tax-free money and you can do whatever you like with it. You're reimbursing yourself for a past medical expense. At this point, hopefully it's paid off and now you can go off and use that money. So that's a huge, huge advantage. Our president used that once. He had a really big hospital bill, and years, I think about 10 years down the line, he ended up reimbursing himself for it. And he ended up using to buy parts to fix his plane. He had a little small tail dragger plane, and he needed some repairs, and those things are not cheap. And he ended up using that money to repair that, but it was really for a reimbursement of medical expense. So just keep that in mind. It's if you use it, you can use it very savvily and very, very helpful. So what happens if you use funds and it's not medical expense qualified? Well, there's a penalty. And the penalty is going to be a 20% penalty, right? So the 20% is going to be on the expense that occurred. So if you pay $100 and it wasn't medical expense, well, 20% is your penalty for that. You can invest it even if you're no longer eligible to fund it. What that means is if you're an individual who's no longer, on a high deductible health plan or just got on Medicare or becomes a dependent on someone's tax return for whatever reason, if something happens where you no longer qualify for an HSA, it doesn't just go away. You don't have to get rid of it. What happens now is you will ultimately you can just invest it, continually use it for medical expenses, but you can't contribute to it personally. That's $7,200 to that, 3,100. So keep that in mind. After age 65, your HSA becomes very similar to a traditional IRA, where I would say traditional and a Roth. You can decide to either use it for medical expenses, or even if you didn't use it for medical expenses, what happens is the funds just become taxable. You don't have a penalty. You just pay taxes on it as income. So I'm 66 years old. I have, I want to go on a vacation. I have some money in HSA. That's not a qualified medical expense. Worst case scenario, I take the money out to pay for that vacation and I add that amount to my income of that year and I pay it at my current tax rate. If I can use the process of reimbursing myself for past medical expenses, it would be tax-free. Or if it's being paid for a medical expense, well, obviously it's tax-free. So keep those things in mind as well. Look at the chat box, making sure we're good. I think we're good. So what happens when you pass away? What happens to the HSA account? So two different options. As a spouse, it becomes his or own HSA to use for their life and for their medical expenses. And they can use it the same way you have been during your life. And what happens if it's a non-spouse? Well, it's no longer an HSA. And the FMV becomes taxable to that beneficiary in the year that they die. Now, if you had any qualified medical expenses within that year, that would reduce how much becomes taxable to you. We have a Q&A question real quickly before I move forward. And one thing is, can you open an HSA with no W-2 income? If you have an HSA plan from previous times and it's still there active, absolutely. You can open it. You can transfer the money over from the current existing HSA plan to continuously invest it, self-directed, and grow it. But what you're limited from doing is contributing to it. So you cannot add on an annual basis to that account from your personal funds. But you can absolutely have one. It doesn't go away. You can't add funds to it. That's really it. But if you're starting from scratch and you don't have W-2 income, then unfortunately you cannot. If you don't ever have qualified medical expenses, you are a robot, or at the worst case scenario, you just take a distribution after age 65, or you pay the 20% tax, right? But everyone has medical expenses. I mean, I don't know one person that does not. So everyone has medical expenses. So just, take the money from your HSA, pay for those medical expenses, use it to reimburse yourself, use your CPA to report that. What happens when you take money out of an HSA for medical expenses is you get what's called a 1099 SA, which shows the amount that year that you took out. And that would be what you show your CPA, your accountant, whoever's doing your tax return. That's what you show them. And they will say, okay, well, these used for medical expenses. You say yes or no, and you tell them, and they will report that and all. And that's it. The IRS would be, if the IRS came down and said, hey, we want to make sure that you were correct and you used it for qualified expenses, well, then you would just show them the receipts. So that's kind of how that kind of plays out. So keep that in mind. So useful publications, so I can get on to the ESA portion of the presentation. The last segment is going to be publication 969, is going to be health savings accounts and other tax favored health plans. Again, 502 will show the medical and dental expenses included in the coverage of the HSA. And the IRS publication, can be downloaded at irs.gov, or simply type in IRS publication 502 in Google or 969 in Google, and you will see the PDF and can kind of scroll through it. It's actually a lot easier to read than you think. I believe 502 has like a bullet point type situation where you can it lists out what's qualified and what's not qualified. So it's fairly useful. If you have an HSA plan, just take a look at it. So and make sure our Q&As are good before we move on to ESAs. Someone said, can I give a couple websites where people can find HSA plans? I would, inquire with either your local bank or who you bank with, see if they have those types of plans. Or of course, IRA custodians, and who you choose. You want to choose Quest Trust Company. And is there an alternative way to start an HSA if your med insurance is not considered high deductible? Unfortunately not. You need that high deductible to be able to qualify to start one and contribute to it. Again, if you have one previously, you're okay. If you already have an HSA and you leave your job and start working on your own, you can contribute to your HSA plan or continue to do so if you have now a high deductible health plan to go with that. But if you don't have that plan, then you can continue to use the HSA, but only through investments. So those are just a few of the questions there that I had in the Q&A box before we move on to ESAs. At the end of this, again, we're also going to be sharing information so we can schedule calls or whatever if we need to go in more detail for personal situations. So Coverdell ESA accounts. I'll have to spend a lot of time on the HSAs. I'll try to go fairly quickly here, but with enough information. So Coverdell education accounts, ESAs. So now we're changing gears, going from we're scared of health expenses, but what about education expenses? The average American is spending a lot more money on student loans, right? So we know that's a big issue right now, and so keep that in mind. So what is an ESA for? Well, it's for qualified educational expenses. So it's very similar to the HSA, where it has a kind of a niche expense that you can use the ESA for, but it's education. And the thing is, the interesting part is for children, or really covers the expenses of anyone under the age of 30, but the ESA can be initiated or started or opened for a child under the age of 18. Now, when I say that is because if they're over the age of 18, you can no longer contribute. As you can see here, the maximum annual contribution is $2,000. This is not too high. So it is very important to kind of do this when they're young. That's what I see most common. Most common people start setting up ESA accounts. I set one up not too long ago for someone who was 8 months old, because they're starting from scratch. They're going to start from year one, put $2,000 in every single year, and continuously invest it to ideally grow on the compound interest. So that's kind of the idea behind it. If you start young, you can grow and grow this account and prepare them for the educational expenses, right? So keep in mind, if you only set it up for people under the age of 18. After the age of 18, they can still have it and utilize it for education expenses, but they're stuck to what they have or what they make from further investments, and they can continue to utilize it up until the age of 30. At the age of 30, there are some things that will happen there, but it either ultimately becomes, income for the individual, or they can pass it down to maybe even their children. So we'll go over those stuff here in a second. One of the biggest questions I get is it similar to a 529? So, and the answer is no, and it's actually kind of different. The ESA is very, very specific in the fact that you're putting money in an account and using it for investment purposes and taking the money out to pay for qualified education expenses, right? And it kind of goes on for any education expenses, K through, high school, and goes on to college, right? So whereas the 529 is specific to tuition, and has very limitations. And I believe also it kind of depends on what state you're in, et cetera. So this is kind of very different than an ESA, where ESA doesn't matter what state you're in. It's not just for tuition. We'll go over some other expenses that qualify as well. But it can be invested into non-traditional assets as well, right? It can be invested into real estate, right? So keep that in mind. Now, what can you pay for with your child's ESA? So of course, tuition, right? But it doesn't stop there. Books, uniforms, school supplies, tutoring, dorm fees, transportation fees, extended day programs, internet access. That's the most interesting one. People seem to think that, oh, I didn't know I could do that. And the reason being is because you need internet these days to do homework. During COVID, well, everyone was home and schools were closed and all. They needed the internet. So you can even utilize the ESA account to pay for that expense as well. And it kind of works in the same kind of concept where it can maybe pay the expense or maybe just reimburse you for the expense. And then there's more, of course, listed in publication 970. So again, going back to how that's different from the 529, the 529 can only cover the tuition cost and the state run. So keep that in mind. And you can have both. You don't have to choose group 2 and one or the other. You can have both accounts. So kind of alluded to a little bit earlier, what happens when the account holder turns age 30? Well, they can either pass it down, which I think is the most popular route to do. They can pass it down to a younger child. This can be sibling, a step sibling, a third child, a first cousin, son-in-law, daughter-in-law, you name it. You can pass it down to really any child under the age of 18 so they can now benefit them. This happens a whole lot. I mean, our president, Quincy Long, he actually has ESAs for his 2 daughters. And it was funny because one of them, he was investing it, and it was invested into an asset where it wasn't easily liquidated. It was a real estate asset. It turned out it was a very hard thing to sell. It eventually did, but when it did, she was done with college and she was older. So what did he do with the money? Well, no worries. He still put a lot of work into that, but that ended up just being, maybe some of it went to that individual account holder as income, but I think most of it, he passed it down to the sibling, which can eventually be maybe even passed down to that person's daughter if they wanted, right? So you don't just lose all the money. It's still worthwhile, and it can still benefit maybe not the child, maybe the grandchild if some situation like that arises, or maybe they get a scholarship in college and they don't need the education, the ESA anymore, right? They have a full ride, So there's situations where maybe you don't need the ESA anymore for that specific child, but it doesn't stop right there. It can help and benefit someone else. Now, what happens if you don't use the money for an education expense? Well, it just becomes income, and there's a 10% penalty. So when we looked back at the HSA, they penalized you a little bit harsher. Here, they're only going to penalize you 10%. Right. So let's look at a case study. So I like to go over case studies in ESA accounts because I believe it takes a little bit of creativity. As you can see, starting off, it's only $2,000 a year, but eventually you can beef that count a little bit more. But this is an interesting case that we have seen here that I think is to this day kind of a really good way that the ESA was utilized. So we've changed the names, of course, but the meat of this case study is accurate. So Andy wanted to pay for his daughter's private school tuition by doing a wholesale deal in her ESA account. So yes, you can do wholesale deals in IRA accounts, self-directed IRA accounts, and that includes the ESA account. So what he did is he opened the account and made $100 contribution. That's all he put in, right? He didn't get close to $2,000, but all he needed was $100. He submitted the contract to Quest with ESA as the buyer. So what it read is Quest Trust Company, FBO, client's name, ESA, and account number. That is the actual entity. You got to remember that these things are entities, just like LLCs and trusts. So they can do things similar to those and what we can do as people. The offer was accepted with only $10. So he was able to negotiate and get that offer accepted with $10. Could that have been $100? Sure. Could that have been $1,000? Sure. Could that have been $2,000? Absolutely. Right. So that's just what he negotiated. But in this case, he was able to do it for very, very low cost. But his idea was he's going to sell that contract, and he was able to do it fairly quickly. He had a big list. He wholesaled it out. And 8 days later, that contract was sold, and someone paid $13,400 for it. That means $13,400 went to his daughter's ESA account immediately after 8 days, after just putting up $10 and maybe paying some Quest fees. They made $13,400 that can now be taken out immediately to pay for either the private school tuition, or maybe let's say that was paid for. Maybe it was for the books, the uniform, whatever's going to be needed moving forward, the internet bill. Maybe it's going to be just used to go on to the next deal and really beef it up to make a really big college fund for her. So that was a very, very interesting way that you utilize the ESA account to beef it up very quickly. And the reason why is, I mean, obviously he was working with a little amount of dollars, right? So he had to be very, very savvy. And I believe in this case, he himself was a wholesaler, so he knew the ways to do these things. And that's where it goes back to just investing in what you know may give you a better benefit and may give you benefits like this. So I think it's definitely worthwhile. So I'll leave you guys with, I'm gonna check the chat box real quickly before I transition to the next thing, but what people at the bank can help finding HSA plans. Rose, I would recommend honestly just calling in to see if they can, or looking online. I'm not too familiar with it. My HSA plan is through my employer, and then it was set up with Bank of America, just to give you an example. But I would assume, by calling and saying, hey, I'd like to inquire about an HSA account or a health savings account, they may have that option, or looking online, simply put. So the final thought I'll leave you guys with is, as you can see, there's a lot of expenses out there that we as Americans are worried about. The self-directed IRAs can help you with, not solve all the problems. HSAs and ESA plans are two of those accounts that can help, and again, not solve the entire problem for you guys today, and you may or may not qualify for, but maybe something to consider. If you're an individual considering it or qualifying for it, well, then we can definitely assist you, right? We process very fast investments, right? We are a network of opportunities. We host educational events. These things are for education, but then we have our networking events as well to provide you opportunities to invest that money. And they're all free. So it helps everybody when that type of information is out there, right? Our staff understands these kind of non-traditional assets and investments you're trying to do within the accounts. And our group of IRA specialists are very well versed in the publication of what you can and cannot do with these IRA accounts. Again, there's 7 different types. And our fees, are pretty straightforward. We'll be very candid with you on how we work and what's going to cost you to do an investment, so you can factor that into your investment and your return. And we don't charge you extra to do anything else that we promise you from the front end. So I highly encourage you guys to take a step and kind of set up a conversation. You can either scan the QR code with your phone and it'll show you immediately my availability. Now, however, there's a lot more IRA specialists out there than myself. Right? As you know, Nicole Bako is on this chat box as well. But feel free to email me if you don't want to do a consultation. Email me questions at juan.deshon@questtrust.com, and I'll make sure that either myself or Nicole will answer that question. If we need to set up a call, we definitely will. We want to be able to help you out. On top of that, for joining today, just kind of a thank you guys. For anyone here interested in HSAs and ESAs, contact myself or Nicole. We'll waive your account opening fees for the HSAs and ESA accounts. Typically costs $100 to set up the accounts, but I want to help to get those started. And I know those get started with lower amount of funds for the most part. So, taking that burden off there is going to help you guys out. All you got to do is contact myself or Nicole Bako. My email is juan.deshon@questtrust.com, or use the QR code and you'll immediately see my availability and be able to set up a consultation, put in some notes, put in your contact information, and I will give you a call at our scheduled date. And it also adjusts for time zones. So I'm in Central Time here in Texas, but if you're not, if you're in California, or if you're in Florida, it'll still adjust for those 2 things. So I thank you guys for your time. I appreciate your participation and the questions. And if you guys have anything else, you feel free to reach out. That is all I got for you guys today. So thank you guys. We'll leave the chat. We'll leave this open a little bit. Actually, you know what? Sorry, I'm going to go ahead and share my screen one more time. I'll leave this up a little bit. I'm going to hide my screen. But if you guys have any questions, we'll talk soon. Thank you guys.